Barry Knapp with Ironsides Macroeconomics. I'm recording this video and podcast on Sunday night, December 12th. S&Ps are up 12 points. Bond treasuries are up about a basis points across the curve. Bitcoin's recovered a little bit over the course of the weekend, and the dollar is flat. But this discussion really isn't about current market themes, because we just wrote this weekend the second of our three outlook notes. This is the one where we focus on thematic investing and try and think about longer term macro themes that could persist throughout the entire business cycle. A year ago, our themes were echoes of the 60s. That's the first time we wrote about similarities of the current policy environment, what things were like back in the 1960s, using that as a bit of an analog for thinking about the current environment. The second theme was Schumpeter's Gale, the pandemic. That's the idea that the pandemic accelerated the process of creative destruction. We then wrote about rebuilding the US capital stock, another section on deglobalization, collectivism, and mercantilism, and then wrapped it up with the end of the 39-year bond bull market. We describe all of those trends as generally on track a year later, though we didn't have all that much deglobalization, though what happened in 2021 made the case for deglobalization that much more compelling, with all the various supply chain disruptions that are persisting to this point. So this year we decided to write, it's only 4 themes this year. We're writing about the length of the business cycle. This is an issue that's come up continuously. And even when we think about rebuilding the capital stock, having a long enough business cycle is crucial to that. We had the most forceful policy response since World War II. And there is, of course, the possibility that we have a boom bust cycle, that we go straight to the 70s and we end up with a very short business cycle. There's one notable broker dealer out there talking quite a bit about having a very short business cycle. We then went on and wrote about whether we should still be overweight the US market, equity market, that is. We get asked this question every year. The mean reversionists tend to get this idea that they should start investing overseas, and the US has been outperforming for a long time. So that's the second of our themes this year. The third one is a recovery in labor share of income and the implications of a recovery in labor share of income. One has already begun, that is a recovery, but whether this will turn out to be an issue for the business cycle, for profitability, for margins, and for equities is a big open question. And then we wrapped it up with our case for effectively a higher terminal funds rate and structurally higher bond market volatility. So those are the 4 themes this year. Beginning with the business cycle, as we're prone to do, we went through the history of all of the recessions going back to World War II. There's a table in our note that walks through just how fast growth was, how fast consumption was, how fast investment was in each of these business cycles, and what effectively ended the business cycle. What you find is, for most of the post-war history, monetary policy played a very significant role in ending the business cycle. Invariably, the Fed would tighten and the economy would go into a recession led by the housing market more often than not. That started to change, though, in the globalization era, when consumer prices were restrained for the last 3 decades or so, the great disinflationary period. Instead, then, what we wound up with was something that looked more like Austrian malinvestment busts, right? We had the tech bust, and then we had the housing bust, the mother of all Austrian malinvestment, misallocation of capital busts. When we think through those dynamics in the 20s, it seems most likely that ultimately inflation and the Fed policy response to inflation is the most probable candidate for when the business cycle ends. And so we went into great discussion, depth discussion, thinking about that issue. But one chart we think stands out, and we'll show it to you here if you're watching the video, which is marginal costs and profit margins. And so we use prices paid, prices received from the various Fed manufacturing surveys and show how at the beginning of a business cycle, invariably prices paid goes up a lot, prices received lag a little bit, then they start to converge, and profit margins recover primarily because of operating leverage. Our thesis here is if inflation slows to something, a trend below 4%, like was the case in the 60s, then we could have a fairly long business cycle. If inflation settles above 4%, it'll get embedded in expectations, and it'll be problematic for companies to pass that through. And that's where we wind up with a shorter cycle. So for now, that remains our base case that, yes, of course, we're well above 4% currently, but that we will settle in 2022 and into 2023 at a level something below that, but well above where we were prior cycles. That would make it something like the 60s, meaning we won't go straight to the 70s. And we can have a reasonably long business cycle that at least gets us through the first half of the 2020s. So that's it on the cycle. The next question was this idea that we should stop overweighting the US equity market. And so for us, there's a bunch of different questions involved in this. The first one and the one point that we have some degree of sympathy for is this idea that some of the other developed world economies are more cyclical, right? And they should be better reflation beneficiaries than the US, given the role that tech plays in the US market. Our sympathy for being overweight the rest of the world pretty much ends with that point. And a large part of the reason why that cyclicality argument doesn't work, in our opinion, is because the profitability of European banks, Japanese banks, Chinese banks, or a whole nother can of worms, is so far inferior to the US banking system that if you buy those markets, you have the banking system as a major drag on your performance. And we'll show you a chart here of global financials return on assets. You could see even at the end of the last or the cycle before the global financial crisis that became the global financial crisis, ROA in the European banks was still only 50% of what it was in the US banks. The only reason their ROE got above the US banks is they applied even more leverage than the US banking system did. So European banks still have plenty of latent loan losses. They have a bad regulatory and monetary policy environment, and we see no signs of those banking systems becoming profitable and creating a broader macroeconomic credit impulse either. So those are for us are very strong reasons not to invest in Europe, not to mention Europe, Japan, or China, not to mention our whole mercantilist theme, which continues to persist. Now, we do think there's a chance that Germany could be the first mover. With Merkel finally gone, they may decide, like they did in the early 2000s, that they need to restructure their economic model, move away from export dependency. And if they were to do that, then that would probably be the first sign that, mercantilism has been discredited and we'll start to move away from that. China struggles with that issue. People like Mike Pettis have written a lot about this. Again, that's another reason not to invest in developed world non-US. And then the final point, we haven't talked about the US at all, is that the US economy is the most dynamic of the major economies. One of the ways we'll show you that is through a chart on new business creation. There's a new statistic that the government started to release where they take weekly applications for employee identification numbers. Those were somewhat stable in the 60,000 range in 2017, 18, and 19. They exploded during the pandemic and are higher even in 2021 than they were in 2022. Obviously, we have a big increase in labor dynamism, people moving from job to job, which should be a productivity positive. I'll talk about that a little bit more in a minute. But just the dynamism of the US economy, the ability to really integrate technology innovation into operations. There's plenty of technologists out there. There was an op-ed in the Journal from a former Google exec who says that China's ahead of us on AI and ahead of us in new semiconductor production, so on and so forth. They still are not using the technology in the way the US uses the technology. That's why we're in the upper right quadrant of productivity and per capita income, and China is in the lower left corner. So For those reasons, the technology innovation adoption is yet another reason why we would continue to overweight the U.S. relative to developed world outside the U.S. So moving on to the section we called Power to the People, which is about an increase or recovery in labor share of income. Labor share of income was very stable in the 60% range in the 50s, 60s, 70s, 80s, all the way until the 90s. It started to slip a little bit and then collapsed in the 2000s when China's market share exploded and we went into this whole disinflationary era. It's recovered now to about 60%. We think it's going to go up further, but that need not be a huge problem for margins as long as we really do have a productivity dividend from all this labor market dynamism. It really is the big issue. So we've shown on a number of occasions, we could show you here again, how labor income already started to rise before the pandemic as that China shock was fading. Those wages are going to continue to go up. Labor slack is even tighter than it was in February of 2020 by the basis of our labor slack indices, even though participation rates are lower and they're heavily weighted. So it just shows you how tight the labor market is. Of course, many of you may have seen the 11 million job openings from the JOLT survey released last week. Nonetheless, if there is a productivity dividend from this, as we expect, because labor dynamism is picking up, that's worker reallocation, the number of new hires and separations, people going to do jobs they really want to do. If we do get the productivity dividend, that'll prevent margins from getting crushed. It's the key issue on a go-forward basis to this theme. And then finally on the natural rate of interest and structurally higher bond market volatility. We went back, we touched on this a little bit in our 2022 Outlook note and got a question from a client we thought was a really good one about how our assertion that we didn't really reach our endogenous terminal funds rate in 2018. And we had to go back. We'd written a report about it at the time, actually in early 2019, about how the pullback in housing activity in 2018 was almost exclusively associated with the Tax Cuts and Jobs Act, just like what happened in 1987 after the 86 tax hike diminished the attractiveness of mortgage interest. The same thing happened with the SALT tax deduction and the higher standard deduction that caused housing activity to fall for a year only. And then it turned around and had a very vigorous recovery in both 1988, but an even stronger one in 2019. We included some academic research in that report that we wrote all the way back in 2019 as well that supported our assertion. But we don't think that the economy, there was any real slowing of economic activity in the US attributable to monetary policy in 2018 and 2019. The slowing we had in capital spending in 2019 was a consequence of President Trump's trade war with China and the hit to business confidence, the global trade and manufacturing recession. The Fed ultimately ended up tightening, but that was because of an exogenous policy event, not endogenous. We reached the speed limit at a 2.5% policy rate. So we think that that policy rate can go considerably higher. And we think that volatility is going to be structurally higher as well. We've talked a lot about the role of Fed asset purchases of mortgage-backed securities and what that means for volatility. And we'll show you a chart here that has volatility falling throughout the entire QE period. That really is the most persistent effect of QE, is the Fed buying all those mortgages and not hedging that mortgage interest volatility. But we've also had a structural change in the market due to regulatory policy. So we have higher vol of vol, much like what's happened to the equity market. Local vol will be lower, but vol will be up because of structural changes in Dodd-Frank that attempted to push some of this market making out of taxpayer-supported banks, and it went into less leveraged institutions like hedge funds, and we keep getting these bond market accidents. And then fundamental volatility ought to be higher as well, because we do think we're in a higher inflationary regime. So those are our themes for the year. As far as getting the implementation ideas around all those themes, you'll have to become a subscriber for that. We do have it in our note. By the way, we don't always say this, but by all means, have a look at the disclaimers at the end of this email associated with this, this audio and video summary. This is Barry Knapp, Ironsides Macro. Next week, we'll get out our 2021 year in review. Always a fun note to write as well, just to think through everything that happened, where we were right, where we were wrong, and give you some ammo if you need to write letters to your clients to explain what happened in 2021 as well, wrap the year up. So have a good week, everyone. We'll try and get out a note around the Fed this week if we think there's something notable. We do think that there is something they can do that would be a much more effective way to tighten policy relative to what they're doing now, which is actually making policy more accommodative if you look at real rate curves. And that would be, rather than going straight to rate hikes in March after they accelerate the taper, presumably they're going to accelerate the taper, we'd like to see them go straight to balance sheet contraction. If they went to balance sheet contraction, they'd actually get a steeper yield curve. They'd get higher bond market volatility, higher rates in the long end, potentially cool off the housing market. We're going to be on CNBC kicking off Squawk Box tomorrow morning. We'll probably discuss this issue then as well. Barry Knapp, Ironsides Macro. Have a good week, everyone. Thank you.